This week was all about the Fed, and while they didn't cut rates, they did give us a lot to think about. The Fed left interest rates unchanged as expected, but the tone was more hawkish than the markets hoped, and their latest projections do still show 2 rate cuts this year, at least on paper anyways, but now 7 Fed members believe that we won't see any cuts at all this year. And that's up from just 4 the last time we got the dot plot that shows these numbers. And they also downgraded the economy, at least their outlook on the economy, thinking that GDP is going to grow more slowly, we're going to see higher unemployment, and inflation is likely to continue to move up. But weirdly, Jerome Powell continued saying that the labor and economy as well are strong, while they also admitted that tariffs are going to hurt both of those things, the economy and the labor market. And he forgot to mention the fact that the Fed left rates low when inflation was rising because they were using outdated numbers while telling us that they're going to be looking forward now, and that does get me a little worried. But meanwhile, Fed Governor, that's Christopher Waller, he was outspoken again, saying that he believes the Fed should start cutting as early as next month. And he pointed out that imports only drive about 10% of inflation, and said that, the weakening labor market can't be ignored. He's worried that, waiting too long is going to do more harm than good, and I tend to agree with that. We are seeing plenty of signs of weakness, including warn signs, which are basically advanced warnings of mass layoffs. And that came in at their highest level that we've seen if you're ignoring COVID and the great financial crisis, so kind of concerning there. And jobless claims are rising, plus big companies that we've seen like Intel and Amazon are cutting jobs. And tourism's actually down too, which could be big because one of the last job-creating sectors we've seen has been hospitality. And retail sales, they came in soft for May too, especially for big-ticket items, although core sales, which basically does get factored into GDP, were a little stronger. And industrial production was down, and factory capacity rose, which are, potentially signs of deflationary pressure, which would be good for mortgage rates. And then last but not least, oil prices have dropped in recent times, but that was kind of before the whole Middle Eastern conflict. And around the world, South Korea made a move that could eventually help U.S. rates by signing a deal that's going to allow them to invest more in mortgage-backed securities. It's a small step, but it is showing that there's still foreign interest in our housing market. So coming up next week, we're going to get housing numbers, an updated GDP reading, and the Fed's favorite measure of inflation, which is, of course, PCE. I'll see you next Friday.